Yeah. So good news for that. I mean, that's so good for him. I mean, you know, I thought it was pretty progressive, pretty aggressive move on his part. But yeah, it's pretty hard to turn to the left. But I think Biden's got the right idea. He's going after the younger generations and saying, "Hey, you guys have got the shit end of the stick. We're going to try and do something to fix that." As opposed to the Republicans who are too busy, you know, liking gay models on Instagram while trying to ban drag shows, thinking of stupid nicknames for each other. Man, so anyway, we'll do one more thing with the news. So people have been talking a lot about us going into a recession. So it looks like that's probably going to be likely. Um, Jerome Powell, who's the head of the Federal Reserve Bank, um, is going to raise rates probably again. And the idea behind this is they've been raising interest rates a lot, and this affects what banks can lend at. And so when you raise rates, it shrinks the amount banks can loan, right? And it costs more to businesses to borrow. This tends to then shrink the job market, cause less jobs, which ideally what they're trying to do is stifle wages to keep wages down because wages have been growing pretty quick.
So, Duncan,
Yeah, go
I
for
don't
it.
want to take too much of like a left turn here,
No.
but from the perspective of the average person, when the Fed raises rates,
Mm-hmm.
what does the average person notice in terms of their savings and the cost to them when they're borrowing money? What does that look like?
To the average person, so if you're borrowing for a car or you're borrowing for a house, the interest rate that you'd have to pay back will be higher. Right.
And so if I were to get a new loan
Mm-hmm.
as they're raising rate, I'm going to be paying more
Right.
because I'm going to get a rate that's not as advantageous to me, regardless of my credit,
Right.
and compared to before.
Right.
Simultaneously, in my savings, I'll see a higher rate too. So I'll theoretically, I would make more on my savings account, wouldn't I?
No.
No.
No. Your savings account's going to be the same. This is for interbank borrowing. This has nothing to do with your interest in your accounts.
So it doesn't really change the base rate on which my rates in my accounts are based, with the exception of new loans.
No, this is just the borrowing rate.
So really, all the way around, for the average person, it's a crappy deal. They're not getting a good end of the stick anyway, because it's not going to help them in their savings.
No.
It's only going to hurt them in their new borrowing.
Right. So the Fed's big concerns are So the Fed's big concerns are inflation and employment theoretically. And inflation's been high. I mean, it was up to like 12% last year. It's down to like 6 something now. So by raising rates, what happens is it costs more money for businesses to borrow money. So businesses have less cash on hand. So what ends up happening is businesses tend to lay people off or not hire. So it shrinks the number of jobs in the market, right?
Sure, they don't want to spend. They don't want to spend as much because they don't have as much literally sitting there.
Yeah, and they don't have access to loans that are
Right.
affordable, right? So that's generally what happens. So their concern is this: is right now inflation rates are high, right? Even though they have been coming down, they're still really high. You want that ideally to be about 2.5% to 3%. You don't want it to be much higher than that. And so right now it's whatever 6.5% or whatever, so it's pretty high. So they're concerned about inflation being an issue. So they figure, okay, we think the main cause of that is wages, not the supply chain, not coming out of a recession, not the fact that while people were in COVID, they weren't spending money and they got some stimulus. And so Americans, especially middle class and upper middle class people, were able to save almost $1 trillion combined. And now they're spending a lot of that money. So demand's artificially a little bit high. They're not factoring all these other things that go in to it. They think wages are the main cause, right? And if wages are the main cause of inflation, well, we need to stamp down on wage growth to lower inflation. That's their thought process. So this is what they're doing. They're calling it a soft landing. Essentially, what they're doing is they're going to raise rates again, force a contraction in the job market, which will cause hopefully a temporary recession, right? And the idea is that wages will stop growing, and that'll bring down inflation. Okay, their argument is if we don't do this, then wages will keep growing, and then what'll happen is businesses, because they have to pay more, will then inflate their prices, so inflation will grow, and then workers will demand more money, and then you'll have a cycle where this keeps going, right? The other side of that coin, where if they're wrong and wages aren't the problem, right, then what'll happen is they'll force a recession here where wages will stop growing, but it won't affect inflation, and inflation can continue to go up, or inflation could stay where it's at. And if that's the case, your money's not growing as fast as the cost. So now what you're called when it is a situation called stagflation, which means now people can't afford to do stuff, so they're cutting back more and more and more and more, but it's not affecting inflation. And if you're in that situation, then you're talking about depression. Almost always leads to a depression. So they're playing kind of a dangerous game of chicken here. Now, the markets are not happy about it. Wall Street is definitely not happy about it. And the other sort of solution, and this has been kind of being pushed, is it's actually more of a progressive solution, but Wall Street seems to be pretty much behind it, which is, why don't you not do anything for 3 to 6 months? Because inflation's been steadily going down. So there's really no need to do anything at this point. And if inflation continues to go down, then there's no need to do anything. But if inflation all of a sudden stables or starts to go up, then there'd be a need to do something, right? And that's kind of the attitude. And so it's like, why is this impetus to push this now? And here's a professor. This is Squawk Box. They've got a professor from Wharton at University of Pennsylvania, and he's gonna sort of explain his theory on this. But he hammers the point home like right out of the gate.
Jeremy Siegel's here, professor emeritus of finance at University of Pennsylvania's Wharton School of Business. I'll just ask you the question I was asking Steve. What's your expectation? Are you at a 50 or 25 for next week?
Well, first let me say that I think that the Fed policy is very misguided. Let me tell you why. This month is the third anniversary of the COVID crisis, March 2020. Over that period, wages have gone up less than inflation. It's hard.
And that's it. We'll watch some more of it, but you can't say wages are driving inflation when the wage growth is less than inflation. They've gone up less, and he's going to get in and hammer it home even more. But I think he's just basically made the argument that I was trying to make. He just made it quicker. But yeah, I mean, he's right.
It's hard to argue the wages are cause of inflation when they've gone up less than inflation. By the way, through history, wages usually go up 1 to 2% a year above inflation. So workers are way behind where they normally are over the last 3 years. But more importantly, Jay Powell himself has said there's a structural shift downward in the labor supply. Well, listen, Economics 101 says if there's a reduction in supply, we have to increase the real wage to clear the market.
And so there it was. And he's right. It's Econ 101. There's a decrease in supply, you have to increase wage. Otherwise, you run into other inflationary problems. I'm not going to get into a big chart about it, but he's right. There's a lot of questions about why. I guess my speculation, and I want to throw this out, just my speculation is part of this is Powell is getting probably a lot of pressure from the Chamber of Commerce because wages are going up faster than they have in a long time, because they've been flat for a long time, and now they're starting to go up. A lot of businesses are not happy, especially big corporations, are not happy about that because it eats into their bottom line. And so there's some pressure on him, probably from them, going, "Hey, we want you to tamp down on wages because we don't want the workers making more money. We don't want to have to pay, equal wages that we would have probably in the 80s for the same job." So I'm guessing that's a lot of it. And, it's a little, I think, irresponsible on his part. I agree with Professor Siegel here, which is just, it's misguided, because you're going to risk a minor recession, which is going to hurt millions and millions of people. People are going to lose their jobs. It's going to affect millions of people's lives. And you're going to be in a position where you're basically playing chicken with stagflation and a depression. Why? Because you're upset that people are making more an hour. So I don't know if you had any more thoughts about that, but I thought, just to give you sort of a rundown of what that argument was. Did you have anything else, son?
No. It's just so interesting why you would want to play a game of chicken like that, when it seems like it might make more sense just to ride it out a little bit.
Yeah, but I think
you could always make that move. You could kick that move down the road a little. You know what I mean? Save that move.
Yeah, but
and sort of ride this out and see how it settles.
Yeah, but if I'm Amazon and I'm Jeff Bezos, these wage increases in the cities, or a lot of the cities are raising minimum wages. This is probably really dipping into my profits. And so, yeah, I'm probably calling the Chamber of Commerce, and, I'm probably trying to call Jerome Powell, pressure on him. And that might be where he's getting a lot of his pushback from. But I don't know. I'm only speculating, but it only really
Mr.
benefits.
Powell, who do you work for, Mr. Powell?
Yeah. Well, he's appointed. He's supposed to be working. He's supposed to be the banker for the U.S. government, but he's also got to think about what's his career going to be like after he leaves that job. You never know.